Welcome to Brilliant Fools. My name is Adam Green, and I want to get a bit technical on something here having to do with real estate investing, because I know that's not only a hot topic, but it's a hot thing that people are getting into right now. And personally, I enjoy it a lot as well. I really do think that it's a good thing to be involved in. It's a great way to make money, to produce generational wealth. It's a great way to lose a lot of money too if you don't know what you're doing and how to go about it. There's something I came across recently. Just a little blurb from Grant Cardone. He's talking with who he says is his daughter, and he mentions a little tax savings tool. So my ears perk up having spent so many years in the tax industry. So I want to go over that now, and let's watch that together and see what it is that he says.
When you get your first job and you're making 200 grand, your goal is to get that 200 grand to 11,000 bucks.
How do you do that?
Your taxes on this is going to be 1,100.
Right.
I want to spend $189,000 on goods and services that could help me make more money next year because I'm never paying the IRS. Let's say I made 200 grand and I could keep 189,000. I'm going to take that and go buy a $400,000 piece of real estate that'll give me $189,000 depreciation, and now I only pay taxes on 11,000.
So how do we get
That's interesting. And it's intriguing. And I think that if we're honest, that's something we'd like to do. All of us would like to pay less in tax. Maybe paying all that we should, but also not paying more than we should, or more than we actually truly need to. And I understand that. I get that. And I'm not mad at anybody for that. In fact, it's kind of part of my job to make sure you get the best possible tax outcome that you can, that you pay every penny you owe, but not a penny more. Does that make sense? So in other words, you're going to be compliant, but you're not going to pay more than you have to pay. One of the problems is that tax code is so extremely detailed, and there's so many nuances, so many different moving parts that it's hard to tell where can I actually save money on tax, where can I not. So this is an intriguing thing that Grant tells his daughter here. Now, first of all, if you can make 200 grand a month or 200 grand a year in your first job, good on you. Do it. By all means, go for that. 100%. I don't know anyone who's doing that in their first year. There are people out there, I am positive, who do that, but holy crow. So that's part of the first part of this math. Let's just assume you end up getting that $200,000, period. The other thing is he's saying to live only on $11,000. I can't pay rent for that. Like, I don't know of anywhere in my area that's even close to under $1,000 a month for rent. And I'm saying rent specifically because he's talking about not buying a piece of property yet. Right. So I'm assuming you're not even owning a house at this point. Okay. There's all other kinds of things that go into that. You may have to get creative with financing this house if you haven't already gotten into a house, and all that's fine. There's no problem with that. These things can happen. I've done all kinds of different or dealt with, I haven't done them. I haven't brokered deals, but I've dealt with all kinds of different tax situations, whether it's subject tos, or wraparounds, or seller financing, lease purchases, lease options, rent to owns, all kinds of, and as well as the traditional financing options as well. So I know how these things kind of go, and it's possible to do these things that he said to do. So we're going to shelve that for now, shelve the possibilities of it, and just say, you now have $189,000, and you're going to go put this towards some goods and services, as he calls it. In this case, he's specifically talking about real estate. Now, it is definitely possible to spend $189,000 on income producing goods and services if you are in some sort of business where that's what you do. So let's say I'm selling some sort of product, and I need equipment to actually manufacture the product. So I'm going to buy the equipment. I'm putting $189,000 into this business, and then yes, I can expense that $189,000. If I'm making $200,000 now, $189,000 is coming off and I have $11,000 left that I'm paying tax on. Okay, that's possible. Personally, if I don't need that equipment, if I don't need that stuff, I'm going to try to save money on it instead. And I'm just going to try to make more money. I'll pay a little more in taxes if I'm coming away with more money in my pocket at the end of the day. Let's shelve that too. Okay, let's move back into the real estate realm now. In that real estate realm, if I am buying a $400,000 piece of property, first thing I'm going to do is assume that I'm renting it out. Excuse me, renting it out, because the only other way I know of to lose $189,000 is to actually sell it for $189,000 less than what I bought it for. That's also not a smart move. I'm going to pay more tax, in other words, if I'm going to do that. But I'm going to assume that he's talking about an income producing property. So he's going to talk about a rental property. When you're talking about real estate like this, there's two different methods of depreciation that we're going to be able to take. One is going to be a residential rental depreciation. The other is a commercial depreciation. If you have commercial real estate, and this includes things like hotels, right? So some semi sort of rental property, but if you have commercial real estate, then you're talking about a 39-year depreciation. Okay, that's a lot of years to depreciate property. I mean, that's almost 400,000 divided by 40, right? In fact, we could say if we're like super conservative and go on the super low end of what the land costs, we'll say the land was like $10,000, right? You can't depreciate land. You're not allowed to per IRS law. So if we say the land was $10,000 and we have a $390,000 piece of commercial real estate, we're still depreciating at max $10,000 a year. That is not $189,000. Okay. Interesting. All right. So where are we going with this then? Well, let's look at the other one. Maybe he's talking about residential real estate. I mean, people do that, right? A lot of times. In fact, this is probably the most common thing. And if you're going to be a real estate investor, you're most likely getting in on the residential real estate side of things. So residential real estate, if I am purchasing that, I get 27 and a half years to depreciate it. So much less, 11 and a half years less than commercial. However, that's still 330 months. So let's say I go out and I bought this thing in end of June, beginning of July. So let's say I get all of July and the rest of the year, I get a full half of a year to depreciate this property. If I take the entire 400,000, I'm going to assume it's a townhouse, condominium, something like that. No land I have to take into account. So the entire 400,000, I get $7,000 to depreciate for the year. If I bought it at the very beginning of the year, January 1, let's assume best case scenario, I get 14,000, 14 grand. That's a lot less than 189,000. So how in the world is good old Grant getting to this point where he's saying $189,000 you get to take on this depreciation? I thought about this and I was like, I am not sure where he's coming from exactly until, let me knock this around, until I thought maybe he's talking about a cost segregation study. Potentially. What is a cost segregation study? Those are fancy words. Those are good words you're using there, Adam, but what in the world does it mean? So a cost segregation study is where you come in and if I buy an existing piece of already rented real estate, let's put it that way. It's already got a tenant in it. It's existing. It's fully furnished. Maybe it's an Airbnb. Let's call it that. Okay. If I've bought an Airbnb, so I've got this short-term rental, residential rental place, it's got furnishings already in it, then I'm going to come in and I'm going to say those furnishings are not really real estate. Those furnishings get to be depreciated at a much faster rate than the real estate portion gets to be depreciated. In fact, if they qualify, there's potential I could take the entire amount of those furnishings in year one, depending on how certain circumstances go and how I set things up. Now, I will say this, to get to $189,000 worth of furnishings is a little difficult. I mean, it's going to have to be some good luxury furnishings inside of I could see a beachfront condominium maybe. Well, maybe not even a beachfront at $400,000. But if you're paying $400,000, maybe you get a condominium that is really, really nice inside. So I have super high-end furniture, tables, chairs, couches, all that kind of stuff inside of it. And I get to depreciate those at a much faster rate. And maybe the actual condo itself, for whatever reason, is only worth closer to $200,000 or just over $200,000. And then maybe, if I do the cost segregation study, maybe I can get away with that. Here's the problem. And here's what so many people run into. I've come up against this so many times over the years. People want to do these things and they want to take these expenses and they want all these things to come together in this right way. But you have to tick and tie so many things. You have to check so many boxes in order for it to actually happen for you. And people, they come after the fact to someone like me who's trying to prepare taxes for them and say, hey, I would like to have this done. I'd like to depreciate these faster. Like, okay, great. Just show me where you have your cost segregation study and then I'll set out all the assets. We'll depreciate the other assets faster. Oh, well, I didn't do a study. I just know what's in there. Good luck on that. Because if you then go and try to take the depreciation and the IRS comes back and says, hey, where are you getting these numbers from? You're going to have to give them the evidence of the numbers. And if you can't, they're going to come back and say, nah, you didn't separate everything out. We're going to lump it all together. And then not only do you still owe the tax that you were trying to avoid, but now you may actually have penalties and interest on it. And if it's material, you could have extra penalties and interest if it's a significant amount off. If they determine you were trying to defraud the government, then you really have major issues going on in that situation. So the bottom line is this: get it sorted before you ever make the decision. If you're one of those who wants to be in rental real estate, if you want to be in real estate investing, not even just rental, get things sorted beforehand. Let me give you a couple of other scenarios as well that come into play with this. One is a very common scenario I come up against, which is a 1031 exchange. You may have heard that. If you're interested in real estate investing, you've likely heard this. A 1031 exchange says you can take real estate and you can exchange it for like-kind real estate. So if I have investment property, I can go and I can exchange it for other investment property. So if I'm renting a house out, I can go and say, you know what, I actually want to have this quadplex that's available or this set of townhomes, and I can use the equity I have in my current rental house, and they'll take that. I can just put it all into this set of townhomes or this quadplex, whatever it is I'm buying. Let's say it's a quadplex. I'm buying this quadplex. I put it all into this quadplex. When I roll that over, I can potentially defer any kind of taxable gain I might have had as though I sold my old house. Now, people will come to me with a scenario like this and they'll say, you know, I had this property, I sold it, I bought another property, and I'd like to record that as a 1031 exchange. Great. First question I'm going to ask, did you ever receive the money in any way? Receiving the money is not just receiving cash, like here's cash or here's a check or it goes into my bank account. Did you ever have any kind of control over the money? Because in a 1031 exchange, you have to have this qualified intermediary. You have to have somebody who's going to take that money for you that you would gain on the sale of your old property, and they hold it until you buy the new property with it. Okay, so that's the first thing. If you ever had control over it, your 1031 exchange is gone. And now you have gain on the property. Even if you put all of your money that you made on the sale of the old property into the new property, your 1031 exchange is done. You owe tax on the gain of that property, and you may have no money to pay it. Okay, that's the first thing. And I've seen that happen over and over again. People coming to me after the fact. Don't come to your accountant after the fact trying to get the thing done. The other thing is the timing window. You have to identify the property you're going to put it into within 45 days. So you sell that old property, you have to have the new property identified clearly, like it's documented, identified within 45 days. Okay, I'm going to buy this new property. I mean, it could be even a commercial rental property, could be a quadplex, could be anything that you're going to move it into. But then you have that much time, 45 days to actually identify it, document it, get it done. And then you've also got to consider if you have boot. Okay. And some of the ways that you can end up with boot in a property that you give up. Well, first of all, let's do this. What is boot? All right. Because, it's not just what you wear on your foot. It's more like pirate booty, right? It's something you gain. And the IRS says, you have a financial advantage in giving up this property that we don't think should be deferred at this point. Let's talk about an example scenario. Okay, so if you have your old rental property, we're going to say this is a more expensive rental property, right? So this is like an $800,000 rental property. Okay, you owe $300,000 still on that mortgage. You paid it down. So after paying off the mortgage, to make things nice and simple, forget about the selling expenses and stuff, we're just going to say you net about $500,000. Okay, so you use that $500,000, you put it all towards a new property that's worth $700,000. Okay, and you take out a $200,000 loan to complete that purchase. All right, your debt payoff on the old property is $300,000. That makes sense. Your new debt on the new property is $200,000. Hey, that's nice. You have $100,000 less of debt than you had beforehand. Since you only replaced $200,000 of that debt, even though you paid off the other $300,000, you have no cash left in your hands. That $100,000 difference is a reduction in debt. It counts as boot. Debt relief. Debt, it's not cancellation because you paid it off, but it's like a debt relief. And you're going to owe tax on that boot, on that extra $100,000. I've seen this happen at a much larger scale, and the guy was not prepared for it. He went through a 1031 company who handles this stuff all the time to make sure he had all the boxes checked, everything ticked and tied to qualify it as a 1031 exchange. And it did. It qualified as a 1031 exchange. He still had to pay tax that he was not prepared for. And he didn't keep any money on hand. He put it all into the new property. Okay. That's a rough thing. So there's two things you probably need to do. One, use somebody who does this stuff all the time, a 1031 type company. Maybe it's an accountant that does it all the time. But the other thing is, even if you use that kind of company, get with an accountant to make sure you know what your tax consequences may or may not be, and that everything qualifies as it should qualify. You may have heard the term, not just 1031, but 1033 exchange as well. A big difference in those two is voluntary versus involuntary. So 1031 exchange, you're deciding what to give up and what to bring in, all that kind of stuff. The 1033 exchange is more like if you have a natural disaster or theft or destruction of the property, condemnation of the property, eminent domain, something like that. It's an involuntary exchange. You have a lot longer to identify the new property that you're going to get. Years, in fact, and you can keep the money. Like the money can come to you. So let's say my house gets completely flooded out, washed away in a flood. Insurance gives me the money. Yeah, even if it was a rental property, insurance gives me the money. And now I have time to decide what I'm going to do with that money, if I'm going to replace that house, where I'm going to replace that house, if it's going to be with like-kind property. So there are some nuances there, just in case you've heard of a 1033 exchange. So those are a couple of the ways that we've talked about. The cost segregation study, which is likely what Grant Cardone is talking to, or look, this little blurb right here that I showed was just an advertisement. So I know there's a lot more that he went into with this whole thing. I just thought I was a little bit curious that I'm scrolling through social media and it pops up as an ad. And I was like, oh, that's an interesting kind of concept. I wonder how he gets to that number. 1031 exchanges are definitely another thing to think about with real estate investing. And there's a couple of other ways that you can get in trouble, but also benefit from real estate investing. One way to get in trouble is when you have an inheritance versus a gift. I've seen this on multiple occasions where parents are getting older. They want to give their property away to be able to take care of themselves, but they're not able to get it ready to sell it themselves. They gift it to the kids. The kids then go fix it up, sell it, have a gain on it, significant gain, and then put all the money into taking care of their parents. It's great. You definitely should put your money into taking care of your parents. That's a wonderful thing. And the older I get, the more I think that's a wonderful thing because I want my kids doing that. But also at the same time, when you gift someone something, their basis in that property becomes whatever your basis was. And in these instances, the parents had held the properties for a long time. So think about it this way. Let's just put a scenario together. Mom and dad are in the house. They bought it years ago for $50,000. It is now worth $450,000. They gift the house to son. Son fixes it up, sells it for, let's say $450,000, right? Maybe he even puts $100,000 into it. So he's coming out because it was given to him. So they're coming out pretty well. He gives the proceeds over to his parents. Dad dies early in the year. Mom can't take care of herself. So he takes care of mom. Mom dies. Tax time comes around. His basis in that property is transferred over from mom's basis in the property, mom and dad's basis in the property. And what that means is that he's got $400,000 worth of gain. Not only gain, but especially, let's say he did it in the same year, he's got short-term capital gain. That's ordinary income. And if he put all of that back into paying mom's medical bills, taking care of good, solid long-term care for her, all of that stuff, he's got a hefty tax bill to pay. And I'm telling you this because I've seen it. I've seen it happen. And it's unexpected. It's like, well, how am I going to pay that? I didn't keep any of the money. Yeah, that's just the way that the law is written. If instead mom just said, son, here, take the money that I have to fix up the property with and fix it up. Or even if the son takes his own money, that's fine. Who cares? Son, just sell the property for me. I'm going to sign a power of attorney for you to be able to do this on my behalf instead of gifting it to you. And then sell the property. Now what happens is they have $250,000 worth of gain that is negated because it's the sale of a personal residence on mom and dad's personal return. That's $250,000 of profit that's negated for each one of them. So ultimately, it could be $500,000 negated entirely because they lived there and they met the qualifications of it being a personal residence. And now there is no gain whatsoever. And all the money that went into or that came from the sale of that house now goes to taking care of mom and dad and making sure they have a high quality end of life. Or mom in this case, if dad passed away, right? It's a big deal. It's a huge deal. So understanding what goes into that beforehand is very important. Another one that I just kind of want to, and the reason why I say that about investing is this was done as sort of a flipping the house kind of scenario, right? But it was flipping the house, not a house that the son had purchased from his parents at a fair market value. It's a house that the parents gifted, just deeded over to the son. Difficult situation. Another thing is you can really benefit from it. If you own a business and that business owns the property that you're working out of, say it's a retail business, maybe it's an equipment rental business, something like that. Say you own the property you're working out of. Consider this. Don't have the operations of the business and the property holding of the business in the same company. You can actually hold the business and hold the property with a separate LLC. There are legal benefits to this as well, but there could be tax benefits because then you just charge rent to the business that operates out of that company. Now, it feels like, man, it's all me. I own the business, but legally, those are separate entities. So your holding company can be a commercial real estate investing company. You can get benefits of depreciation for that property. Yes. You could do a cost segregation to get even better benefits. Sure. But you can also end up with rental income to you, which is potentially has some benefits to it as well, the way that it's taxed and the way it ends up coming out. There are all kinds of things you can do with rental real estate. I think it's a really cool area. It's one of those areas in the tax law where there's a whole lot of leeway to be able to do things that you wouldn't necessarily be able to do in normal day-to-day business or individual taxes. So I like it a lot. There's a lot of potential. There's a lot of hype in it as well. The main thing you really, really, truly need to know is to get all the boxes checked, tick and tie everything, do your research before you ever move forward on these things, and get with a professional who knows what they're talking about in it before you finalize this stuff. None of this is tax advice. I'm not advising you to do this or that. I'm just telling you what kind of things are in the law, what can happen, what are some nuances, all that kind of stuff that can go on with it. And then finally, even when you tick and tie everything right, go and check out conservation easements and see what can happen when the government decides we don't like the law that we passed, so we're going to penalize people for taking advantage of it. Conservation easements. Run down that rabbit hole if you want to. There's a whole lot to say about that I won't get into on this episode. This has been a highly technical episode, but it is an area that I do enjoy quite a bit. So I appreciate you sticking around and listening with me. And then until next time, thanks.